Have you ever felt how the market suddenly bounces back exactly when everyone turns bearish? What if I told you that one single number could reveal whether the market is too greedy or too fearful and even predict reversal before they happen? There is actually a number that tells you when that's about to happen. It's called put call ratio. This will exactly tell you what are the smart traders' positions are. In the previous video, we learned how to interpret open interest and implied volatility and how they reveal the behavior of traders in the market. Today, we are taking the next important step. But before that, if you are new here, hit like, hit subscribe to EagleEye Stocks, where I will share my trading experiences so that you can learn to trade profitably. And also tell me in the comments below what video do you want me to post so that you can learn to take better trades. Let's begin. So before we start with PCR, let me explain you in simple terms what do you mean by buying and selling call and put options again in this video as well. So when I buy call, I am bullish in the market, and when I sell a call, I am bearish on the market, or the market is going to be flat. Similarly, if I buy a put means market will go down, but if I sell a put means I think the market will go flat or will go up. Hope this is very clear to you now. Let's continue with the PCR. Understanding the put call ratio, or simply PCR, is one of the most powerful indicator to measure market sentiments and identify overbought or oversold zones. So make sure you watch till the end, because in the next video we'll connect this with the option pane, where you will actually see how market makers try to trap retail traders. Now you know what is call and put. So the put call ratio, or PCR, compares to the total number of put options traded to the total number of call options traded in the market, which mathematically means PCR equals to total put open interest divided by total call open interest. Let's take for example, if put OI is 10 lakh and call OI is 5 lakh, then PCR is 10 lakh divided by 5 lakh, which is 2 lakh. This means twice as many puts as calls, showing traders are expecting a downside. So in short, PCR greater than 1 means more puts, which is a bearish or oversold sentiment, and PCR less than 1 means more calls, which is bullish or overbought sentiment. PCR reflects the overall sentiment of traders, whether they are fearful or greedy. When PCR rises sharply, traders are buying more puts expecting a fall. But when too many turn into bearish, the market often does the opposite. That's why PCR is also a contrarian indicator. High PCR means oversold or possible bounce, and low PCR means overbought or possible correction. Let's understand the common interpretation of PCR calculations, or understanding the PCR. When PCR is 0.7 means overly bullish. PCR between 0.7 to 1 means neutral. If PCR is between 1 to 1.3, which means slightly bearish, which can be a healthy correction or a consolidation. And above 1.3 PCR means overly bearish, which means market could bounce back. Remember, extreme in PCR often leads to reversals. OI tells us the positions being built, IV shows expected volatility, and PCR adds sentiment. If OI increases, IV is stable and PCR is high, fearful, but possible reversal. If PCR drops while OI is high and price is rising, means bullish momentum may continue. Now you know how to read and interpret the put call ratio, the perfect bridge between open interest and option pain. In the next video, we will explore how option pain shows where the market makers want to close the expiry and how you can use that level to plan your trades. If you found this useful, like, comment and subscribe to EagleEye Stocks for more simple market explanation. We'll see you in the next video. Till then, take care.